The rand's been trading on a weakening bias within the current range of 10.58 to 10.75, as both the domestic as well as offshore developments highlight that South Africa is very vulnerable. Global monetary policy has been the main focus, with the Fed minutes of its latest policy meeting revealing a more hawkish Fed. The minutes suggest that many members believe that job gains, diminished downside inflation, and the financial system vulnerabilities were well contained in the United States. To quote the Fed committee, "Progress in the labour market over the past year has been greater than anticipated, and if convergence to the committee's objectives occurred more quickly than expected, it might be appropriate to begin removing accommodation sooner than they currently anticipated." The committee's expressed its intent to provide additional information to the public later this year. The Bank of England also released minutes of its last monetary policy meeting. They revealed that 2 of their members had voted for a base rate hike, with the Fed and the Bank of England much further along the path towards the tightening of monetary policy than the ECB and the Bank of Japan. Among the majors, the rand remains more vulnerable, and especially against the pound and the US dollar. Global manufacturing, meanwhile, from our 2 biggest trading partners, remains in expansionary mode, yet just above the 50 level. The HSBC Chinese manufacturing PMI for August came in at 50.3 from a prior 51.7. This disappointed the markets. Meanwhile, the Euro PMI remains just above the 50 level. South Africa's July headline CPI slowed to 6.3% from 6.6% in June. This is being perceived as having negative consequences for the monetary policy outlook, as it reduces likelihood of further interest rate hikes as the rand remains range-bound below 11. Retail sales contracted in June, with growth in households' disposable income having slowed, banks having pulled back from extending credits, instilling tighter lending criteria to stave off bad loans. Moody's surprise downgrade of South Africa's 4 biggest banks saw the shares in the lenders lower on Wednesday and piled further pressure on South African markets. Weak economic growth appears to have been a massive, substantial driver of the Moody's rating action, and the downgrade was expected to rein in lending and could even lead to a cut in the sovereign rating, as the economy suffers from the fallout. In June, the S&P cut the country's credit rating, while Fitch affirmed the rating, but placed the country on negative watch. Now that we've seen the lay of the land, I'd like to welcome my guest hosts, Colin Wakefield from RMB and Danny Pienaar from Micromegas. Econo-Muppets, it's been a boring week, right? So we're still within that range, and I mean, obviously the rand behaving relatively well, obviously weakening to the top side. So let's start off the conversation just with regards to obviously the FOMC minutes coming out yesterday, BOE minutes. Interesting in terms of the hawkish stance. So Col, do you want to maybe kick us off?
These committees are very divided,
yeah.
Is the summary. I think that's the interesting part. They've been so dovish for so long. I think a lot of market participants have become a little bit lazy about assuming that the monetary policy stance that we've seen will continue for the foreseeable future. And now we're starting to enter into a little bit of debate. The market hasn't reacted as much as we would have expected. 2 dissenters at the Bank of England actually starting to call for interest rate hikes in the UK already.
We did see the cable obviously rally on the back of that. But yes. I think, you know, you're right that they've been hawkish, but in my view, we've also seen a lot of kind of roller coaster type feedback from the reserve banks across the globe. I mean, if we look at the BOE, if we look at the Fed particularly though, so we had Bernanke leave and Yellen take over, pretty much the same stance. However, there has been that backward forward positioning around when are these inevitable interest rates going to take place.
I think true to say that Yellen's come in and hasn't really found her feet yet. We saw some great US numbers when we were on last, and then she came out and said she's not ready to raise rates. Yeah. The economy is slowing down. We've actually seen some benign numbers over the last 2 weeks. I don't think there's been anything in the numbers to suggest that inflation's out of control, that jobs are out of control. And now she's come out and she's flapping her wings and being a little bit of a hawk. So I don't think she's found a middle ground yet and where to temper the market. So everyone knows that rates will go up at some stage. It's not going to come very soon because the numbers don't suggest that. When the numbers turn and inflation grows and jobs go out of control and there's less people not seeking jobs, then then she'll look at raising rates. But I think until then, she's just got to find the balance within herself and the market in the comments that she makes.
But it was also quite interesting to see how the Fed is concerned about their forward guidance. So they are very concerned about the fact that they want the market to know what they're going to do preemptively. And I think that they're quite aware of the fact that there's a lot of speculation around when they're going to start hiking, what their deemed stance is around the criteria that they put in place last year already, yes, and where we stand currently. So in terms of that forward guidance, I think that's where the market's going to be watching where we're going to from here?
So the big focus, of course, is this weekend at the Jackson Hole Symposium. A great comment that I read earlier in the week is that the previous policy stance expired on the shelf and it reached its expiry date. The unemployment rate was the sole focus and target of the Fed's policy actions. We're really close to their original targets. And as Danny mentioned, we left it a little bit in a no man's land around what the metrics are that in particular the Fed is going to be paying attention to going forward. Yellen is very worried about wages. The topic of focus this weekend is going to be labour, and so we are looking for that next driver, which will give the market better clues as to just how hawkish the committee really is, because Yellen's quite dovish, frankly.
Well, she is, but I mean, I think that if we look at, so we've got, I think looking forward, and certainly for those of us that are looking at data, it's not just about the unemployment, the non-farm payroll, it's also going to be about wage growth, looking at people that are coming back into the seeking job market, looking at those, the wages themselves, how those are growing and the momentum of those. So the underlying statistics with regards to the makeup of the unemployment data will be more interesting than just the number itself.
And also adding to that, I mean, seasonally in the US, it's been summer. So they do have more jobs. They, you know, the outside restaurants, there's more part-time labour taking place. So less people are seeking for jobs and less people are claiming benefits. So as they enter the winter stage of the US seasonal activity, you'll start to see those numbers actually start looking not so great again. So does she then backtrack? They want to raise rates. We know that she has to keep telling the market that, but they have to be clear in terms of what Colin mentioned, their metrics. Have they changed? If so, what are they? The Fed's always been very good at telling the market what they're going to do. You know, they're not going to surprise you.
Which is great. And I mean, I think that, you know, just to round the conversation off in terms of the MPCs, I mean, we've got our own MPC coming up. However, in terms of the global stance, and that's always been the thing that's helped to keep us in track with what we can expect to see on the Rand, is that once again, the market is focusing on the inevitability of interest rate hikes out of the US and out of the Bank of England. Obviously, the Eurozone, a little bit less likely to do so as soon because they've been much more dovish in terms of their economy. So I think going forward, you know, let's talk about the impacts in terms of South Africa. So I want to look at the South African market, where we currently sit, and then look at what the MPC can do about that, if anything, and how we sit in the global picture with regards to those interest rate outlooks in South Africa. So I just want to start off, I mean, for me, it's been an interesting week with regards to obviously the ABLE issues, and then consequently seeing the downgrade of the banks. And I mean, there's been a lot of criticism. However, they certainly are identifying issues that we've spoken about ad nauseum on the show. However, it's now being highlighted again, and the proof of the pudding's in the eating. So what is your view in terms of why they did it?
Well, to be honest, I think that at this stage I have about as much time for Moody's as a leper giving a facial. Our capital adequacy ratio is what I think when you look at a banking sector and how easily they can service debt. Ours is tier 1. So you know, if you look at the banking sector and you take it out of the local economy and you look at our banks and how they've fared since 2008, they've probably been the best that there has been. Versus some G10 countries, versus other emerging market countries, our banks have stood tall, they've stood well, they've looked after credit. The ABLE situation slightly different. You know, they had to go to the market to lend cash, to on-lend cash. You know, that whole system or that whole product was never really going to work in an economy that's slowing. So and I think if Moody's has to be given a little bit of credit, which is difficult for me to say, I think they're pointing to the sluggishness of our economy, and that's been a process that we've discussed from a government point of view, from a national development plan point of view. How do we get the economy growing? How do we get jobs going? And they're looking at that going, well, if we have continuous strikes, if we have continuous labour issues going forward and the government doesn't do anything concrete about it, how many people are going to default on loans? You know,
but that's, I think, the key. And if we look at what happened with ABLE, and that's what concerns me a little bit with regards to what happened with them, I agree with you in terms of the structure of our banking sector in South Africa. However, I think that what they were pointing to is the vulnerability of our banking sector as a function of our underlying economy. If we look at the fact that we've had strike action, we're running 1 in 4 people are unemployed in South Africa. You've got this, I mean, ABLE effectively, the reason for that business, and we look about it with Capitec as well, is the fact that there's such a huge need in terms of those lower earners that need to access some form of credit. However, the credit worthiness or the credit that you need to attach to that lender by virtue of the underlying economy, because how long are they going to have a job? Are they going to go into strike? Are they going to be able to repay their debt? Can they be blacklisted? No, because you're not even part of the credit rating. So all of those things are massive risks. And even the big banks, they do participate in a portion of that, what we call unsecured lending, which does pose us a little bit of a risk. And I think think what it highlights is just those underlying issues in South Africa that, unfortunately for us, one of our strongest sectors, is a little bit vulnerable because of the other underlying issues. I mean, growth rates in South Africa of sub 2% are shocking in an environment where Africa's growing at a general rate of about 6.5, 7. So, you know, what's your view in terms of where we currently stand and the chances of us seeing a further downgrade in South Africa's sovereign rating?
I think I mirror Danny's comments about the ratings agency rating Lehman Paper AAA just before it went bankrupt, one of their most priceless activities. The ratings action was driven by, frankly, the assumption that the state would bail out any South African bank that ran into trouble. And as we saw, there was a haircut applied to the debt of ABLE, certainly the secured debt, and of course very questionable about any value left in the equity. So the Moody's action was predominantly driven by the assumption of state support. I think the weaknesses that you've spoken about, low levels of productivity, lack of investment, labour concerns, unfortunately have been reflected in the sovereign rating. And frankly, and I think the conversation is already starting, there's potential for further ratings action if we don't see a change in a lot of these metrics that have led South Africa to really underperform other emerging markets. The global environment is tough. We know that Europe is in an exceptionally bad way, a huge export market for South Africa. But the local driving factors, which we are all well aware of, unfortunately have not turned for the better.
And that's the concern. And I'm also concerned about the fact that with these downgrades, it puts the banks under more pressure and less likely to lend, which creates more consumer pressure in terms of, you know, being able to access forms of debt or manage their debt capabilities. Also in terms of credits or capital allocations, putting more and more pressure in terms of costing for people to access credit in South Africa. So is this a good thing or a bad thing? Obviously it's not great for the economy going forward. Do you think that this is something that they're going to talk about with regards to MPC? And quickly give me a two-liner in terms of what you think they should be doing.
I do think it'll impact MPC. I think the current market environment indicates that we probably won't get another rate hike. I'm not looking for one at the next meeting. I think that puts dollar rand under further pressure. If you combine US interest rates eventually going higher with what's happened in the local economy, with Moody's downgrading the banks, with further interest in how, or criticism in how our economy is faring, I cannot see another rate hike. I think CPI has already been an indication of that. We've seen inflation slowing. So I'm looking for no rate hike at the next meeting and a slightly weaker dollar rand going forward.
Okay. Now that we know where we stand, the real risks and opportunities, it's time to pull out the big guns. So let's look at levels for the week ahead. Give us some idea in terms of what your views are around the current range that we've been trading and then the conversations that we've been having.
I must just put a health warning. The last time I was here, I said we should go long rand at 10.50, which turned out not so well. I think Jackson Hole is the key event risk this weekend. My gut feeling is that the FOMC is dovish. They're worried about long-term wage growth. And as such, I think that we're probably going to see the range that we've had since March hold. So 10.78 on the upside. If I'm wrong, of course, on Jackson Hole, we're going up towards the 11, the figure. But my bias at the stage is towards the lower 60s, driven by a dovish FOMC at Jackson Hole this weekend.
Okay, fair enough. Danny?
I'm in the same camp as Colin, to be honest. I think the range has held. The range for me is 47.87. And I think, you know, other side of that, we're going to see a 10 to 12% move on dollar rand and probably even more so in the crosses. So for the time being, I think dollar rand will force the top side a little bit. I think we'll test up to 79.81. I think the longs will get out there. You know, we need to respect the range because it has been there since March. I would suggest selling the call long that we've been looking at around 79.81. Probably looking to short a few dollars with stops above 87. Looking for a trade back to sub 60. So the negatives are there, but for the moment, the technical pictures is outweighing that until we get further shocks, and Moody's downgrading the banks maybe again might lead to that, but not at this stage.
Okay, well, thank you very much. So in conclusion, it's very interesting to see that the range on the rand has held, even though we've seen such negative inputs with regards to both the downgrades of our banks, as well as all the negative data in South Africa, and even the Monetary Policy Committee announcements from offshore suggesting interest rate hikes. So for now, both our guests suggesting looking for the top of the current range being about 10.81 down to about 10.78, looking to get out of your long positions and playing that range, being aware of the range and not fighting the technicals at this point. So if you'd like to send any questions or comments, you're welcome to do so at CNBC Africa, #CurrencyWars410, or you can get hold of myself at Brigid R. Taylor for your personal responses to the Forex markets. Until next week, good luck in the trenches.